Okay, so Sham, talking specifically about this drawdown that has happened in the small cap space, we looked at the data and the data says that this is since the time small cap Nifty small cap index started. This is the seventh for the index. This was the seventh most severe correction. However, uh, looking at the stocks beneath the index, this time stocks have fallen much more than the index, which if we look at the previous corrections hasn't happened every time. So in a way, this correction is slightly more severe when we look at the stock specific correction. One thing particular about any bear market or any correction phase is that stocks will fall no matter what kind of companies those companies have been. Whether they were expensive, an expensive stock may fall as well. A value stock will become even more deep value stock. Companies which are reporting good numbers continuously, or companies which are let's say have reported good numbers in this financial year as well, they have also fallen, and we are seeing the same thing across, be it our portfolio, be it our watch list. And I think that's the nature of the market. So uh, you know looking at this particular aspect of the market and how things have been in the markets for last 10, 12 years, and seeing this thing happening again and again, we know that this is the nature of the markets, and this is how it will always be. Wanted to listen from you, because you have been in the markets for more than 30 years. Would you say that this is exactly how this thing plays out every time, and hence this is an opportunity when we talk about the next 1 year, and hence this is an opportunity, that anything that we couldn't touch before because it was expensive, a good company has now become attractive or will now become attractive in the next 12 to 18 months.
See, if you look at the small cap investing that has happened in the last 2-3 years, it has been driven more by liquidity than by consensus or conviction. Liquidity is forcing consensus to act in a certain way. And whether there is enough conviction or not, liquidity is forcing people to act.
Yeah.
So, liquidity driven market in small cap lasting for such a long period of time is unprecedented. And if you see the composition of this mutual fund SIP book, highest component is small and mid cap, and that is some 3 times or something the large cap book in SIP. So clearly, the liquidity is more than this space can absorb. So what happens when liquidity is more than what the space can absorb? Companies come to raise more capital. So companies have been liberally doing QIP, happily taking money. Whether they need or not, they raise money. Now this happened last, in my assessment, in 1994, and it didn't happen in small cap, it happened in larger companies mainly, and then some mid-sized companies did GDRs and all that. But now every small cap company is thinking of doing a QIP because there is a appetite for their stock. So you are having two levels of capital misallocation. One, investor is misallocating capital to small cap through the mutual fund route. Second, companies are misallocating capital because capital is available easily, right?
Yeah.
So generally, when something like this happens, when one of these two happens itself, it has to correct, it has to revert. There has to be a mean reversion. The asset which is created will make the balance sheet inefficient when money is raised at the wrong time without strong reason. Then, second thing is when you give money to the manager and he is going to deploy money, he is actually slowing down the valuation reset, which is what is happening today.
Yeah.
Which means you are trying to soft land the space,
Yeah.
right? Now, from my experience, I have never seen a manager being capable of soft landing a volatile part of the market. He is incapable of that. When I say he, you can include me also in that. This is not our skill. Nobody has this skill. But when you are collecting money, you think that you are going to keep getting money for a very long time. No, this is a fallacy. This fallacy never ends well. That is my experience. So this small cap liquidity that we are seeing today has to first change. It will change. And when the liquidity reduces and then when inflows turn into outflows, that is when the real valuation of this market will get discovered, which will all likely happen this year, or under very extreme circumstances it can further get deferred by a year. But this should happen. This is my expectation based on what my experience is. I could be wrong, but this is what I think may play out. And when this happens, companies will start further moderating in valuations, and one side valuation will moderate, other side this year's performance and the expectation setting will come into play. So some companies will moderate and then quickly regain. Some companies will moderate and then get stuck there. If the immediate future is not promising and the management commentary is not giving too much optimism or room for optimism, right? So all this is going to happen. So it's going to be a year of very high drama, change in direction of liquidity, and a valuation reset, right? When liquidity comes down, consensus will break down and conviction will trip. When all three align, that is when you will see the real market. Okay, so that is some time away. I don't think it will happen quickly. It may take a few quarters of results, because still people may have optimism. So where there is consensus and very high consensus, conviction can break down more easily. But if you are investing very far away from consensus, then there are not too many people who have conviction in the stocks that you own. There, for a conviction breakdown to happen is unlikely, but on low volumes the valuation can come down. Okay, that will happen. Liquidity will become low, and that will bring the valuation down, further distorting your portfolio. It will look like you are having a bigger drawdown. But one good result in one stock or in 2-3 stocks, it will reverse, and then your portfolio normalizes. So what will happen in consensus investing will be very different from what will happen in away from consensus investing. So you can't view it from the same prism. So you need to first in your mind differentiate. You can't say all small cap investing is the same. You can't compare a mutual fund and who is investing on consensus and with some 180 stocks in small cap, and somebody who is having a 20 stock portfolio which is completely away from the consensus. So it's a category level confusion that has to be dealt with. I think market has to first figure this out in their head. I don't know how many people understand this, because I have seen cycles pass without people understanding this. So whether it will be clearly understood in this cycle, I don't know. I'll be happy to see it happen.
I think you made two interesting points, that one, a portfolio which is bottom up and completely away from consensus should be seen differently, and second, in that kind of investing where non-consensus is the way, a marginal seller in a non-liquid script can actually determine the price, and in that short phase of the market of that in that phase, basically things may look, prices may look, or valuation may look very differently, and you may look very different from the consensus.
Correct. That is happening, it will happen.
And another thing probably which comes out very clearly, and from our own experience, what we have seen in 2018 and 19, the correction actually began in January 2018. And I think markets bottomed out in middle of 19. So that took more than 21 months. So, and that's what probably we are discussing here, that correction actually just started again in January, and we don't know how the next 12 or 18 months are gonna be, but it may be a time period when things may be sideways or very stock specific. In a way, it can be a stock pickers market and a good time to do your research and wait for that one day that you mentioned.
It is that time.
Or a group, for those scripts, I mean, over a week or whatever, a month.
And all scripts won't have the same time.
Of course.
One will have in the one
That's the
quarter,
beauty,
another in another quarter. It's like
that in a way is a very good thing, because
you get time.
You get time, and your investors have the opportunity to participate during this time as well. Well, moving to the probably last part of our discussion here, an interesting one today. Uh, so, just 5 or 6 months back, we were talking about every time, and all across, I think we have seen this corporate India being deleveraged. Not, there was a time few years back when there was twin deficit problem, and now we are in the twin surplus problem that, banking is cleaned up mostly, especially the corporate loan side, as well as the corporate balance sheets are cleaned up. And if you look at many other aspects of our country, real wages at the ground level probably after a long muted period coming back up, consumption picking up, stable government at the helm, and then in some ways de-risking by the global corporations from China in their supply chain, helping a lot of countries, including India. In some ways, it has started, and we are seeing that in our companies as well. So, the narrative to put together everything put together, and not to forget the broader level changes done by government of India in the last 10 years, be it RERA, be it GST, and many other aspects of that. Everything put together, the narrative and the story for India as a stock looked very promising, and suddenly that narrative has changed. And I think we should call it that the narrative has changed, and in terms of reality, things may have changed a little bit here and there, but the macros really look promising. So in this whole context of that macros continue to be good, there is definitely volatility or some risk factors emerging from outside India, be it tariffs or other things. So, you know, suddenly that narrative has turned from positive to negative, that how we should look at it. So suddenly everybody from long term to has become short term investor. So in our view, we see that we should keep an eye on the long term and continue to see the positive sides of it. And as these clouds become they just scatter away and then clarity emerges, probably the next 1-2 years we will be back to the same narrative, same story have been seeing, and the stock picking that we'll do in the next 12-18 months should start to pay off. What is your view on this? What would you say to this aspect, that how do you look at for the this whole story for the next 5 to 10 years? Do you think something has really changed, or is it just the sentiment or this heavy drawdown which is just changing the narrative and nothing else, and that probably you would have seen previously as well?
I think the primary driver of narrative is slowing economic growth. When you have slowing economic growth, then you go back to see whether you are pricing it in. And when you look whether you are pricing it in, you are seeing that valuations have already captured accelerating economic growth and not slowing economic growth. You are looking at growth going back to, let's say, 7.25, or maybe under some extremely positive and over ambitious circumstances, 7.5.
Yeah.
Whereas now it is tending towards 6.25, right? If you take that market was wanting 7.25 and it's getting 6.25, 1% GDP growth if you shave off, then the valuation cannot be 50, 60, 80 PE. It has to moderate. So growth expectations is going to be the primary driver of valuations. And the moderation will be driven by growth expectation. Then you go for a reset, saying that what is the right valuation for this growth. Then you start looking at the other levers of the economy, like inflation, interest rates, liquidity, capital investment, individual leverage, how borrowed are families, what is the property market looking like, what is the mosaic of asset valuations across. You just don't look at equity. Today gold is expensive. 12 months back gold was not as expensive, 30% cheaper it was. So real estate is at its historic peak, right, with high supply and very soft demand. Interest rates are actually negative. You must have seen Mr. Uday Kotak's statement that bank is borrowing at 9 and selling and giving home loan cheaper than that. Is a negative. You must have seen the tweet of Mr. Kotak.
Yeah.
So all this has to invert, no? You can't have this. So effectively, interest rate has to align with the borrowing rate of the bank in home loans. So real estate may be in for something. I take that tweet as a cue. So other asset classes are not looking exciting. Equity is expensive. So if equity falls, will equity get bought? Logically, it should. Now, will market allow equity to fall further than what we think it's reasonable? Market will always overshoot at both extremes, right? So if you're going to have a valuation reset on the downside, market may actually take it 5-10% more than we expect, but for a brief period, maybe 1 quarter. Then we have to get optimism into growth with good macros like inflation, liquidity, interest rates, export data, trade balance, improving balance, good capital investment. All this will have to come together again, and growth should probably have a tick of maybe between 15 and 20, 25 basis points. I would expect a 25 basis point incremental growth every year. So, in 2 years, if you are able to add 50 basis points, it's reasonable today, given the way the world is at the moment. If you are able to add 75 or 100 basis points and the valuation moderates in between, then that valuation asymmetry will become in your favor. At that time, you have to back the truck again. Until then, you have to keep investing gradually. So, it's a phase where judgments cannot be formed in a hurry. You have to give time to your judgments to evolve, and you will also have to cut some slack to allow the judgment to change also, because circumstances in the macros may keep changing. And however hard you try to expect and anticipate and predict, you will always be right on the prediction and wrong on the timing. So, you will look wrong on the prediction for some time. So, you will have to manage yourself better on the macros, and I think that sentiment is going to go out of the investor's control. That I am fairly certain. But on the downside, it went out of control on the upside in 2023-24 mainly, and first half of 24-25. Now, sentiment is going to give us a lot of botheration. So, if you have that understanding and acceptance, then the way you respond to sentiment will be better than the way Mr. Market responds. So, you have to do a little better than Mr. Market, hopefully. So, that is a challenge before all of us. It's an interesting challenge. In every cycle, it comes in different forms, under different circumstances, with the different levers. Today, I think valuation is the only problematic lever. Rest of the macro things are all manageable. Where there is overvaluation, the reset will be painful, and it won't again go back to that excessive valuation in a long time to come, because market thinks that when 80 PE comes to 40 PE, it will go back to 80 PE immediately. It won't happen. So, then market has to recalibrate in so many places. So, all this will lead to a lot of churn in the market, and we need to be careful in this churn, not to run into the wrong stocks or stay invested in the wrong stocks. So, we need to align ourselves constantly to the evolving scenario. I think that is going to be the challenge. So, it's going to be interesting. I think it's going to be very interesting, and I'm sure we will learn a lot in this cycle, which will make us better investors. And what we learn in this cycle will be unique to this cycle, and not necessarily always a throwback to past cycle. There will be some similarities, but I won't say that it is just history repeating. It's more like history is likely to rhyme than repeat. That is my broad expectation.
Actually, I was going to end with these two lines, that history doesn't repeat, it just rhymes. So you just said it. Yeah, I think completely agree with you that every time there is a correction phase, you know, on the outside, it seems like everything is new. This time is different. But when you as more time you spend or you introspect, you start to see those signs that have been present in the past, those patterns, those signs, and those particular, I would say, characteristics of any bear market. And that's when you see comfort, that how you navigated last time and the learnings you carried from there, uh, and you improve upon those aspects and then try to navigate these uncertain times. Note that they are easy to navigate, but definitely something, because of your experience or or your, I would say, your homework over the years, that will probably help you in this time as well. So yeah, with this, well, thank you so much.
Thank you. It
It
was
was
good
great.
fun.
Yeah, great conversation in the morning here. Well, thank you so much.
Bye. Thank you so much.